The major indices erasing most of their losses from last week, driven by some optimism that the government shutdown will end soon, as well as easing concerns about the AI trade. Let's bring in Ed Yardeni, president of Yardeni Research, still aiming for the S&P to end the year at or maybe close to 7K. Ed, it's good to see you. There was some discussion this morning that the 50-day was tested and held. You know that when you're down 3 for the week, and that's the worst in 7 months, there's probably time for some consolidation.
Right. Well, I think that's true, but what's really driving this market is earnings. The earnings story has been phenomenal. In some ways, we've had an earnings-led melt-up, which is the highest quality melt-up you could possibly have because it's actually based on the fundamentals. And we watch analyst consensus expectations on a weekly basis, and they've been raising their 2026 numbers. The first and second quarters of this year turned out to be much better than they thought. They thought it was going to be kind of low to mid single digits. It turned out to be a low double-digit increase on a year-over-year basis. And the same thing now is happening with the third quarter earnings reporting season. Instead of up 6.5%, it's coming out at something like 14% for S&P 500 earnings. So that's phenomenal given all the volatility we've had this year.
Right. Sarah mentioned the layoff quotient, though, and Goldman Sachs does have a layoff tracker, 14-year high now. Is that why some of these earnings are coming in so good?
I think that is partly the story, and the big story is productivity. Before the government shut down, we had a very strong number for the second quarter, revised up to almost 4%, and something like, well, also 4% is the Atlanta Fed's last reading on the third quarter. And so here we have real GDP looking stronger and being revised up, and the labor market numbers being revised down. That obviously means productivity is booming, and we're seeing that in earnings. Look, the layoffs, I follow the Challenger numbers, and the Challenger numbers did go up a lot in last month, but that was mostly technology and warehousing, and a lot of that is productivity related. It's not as though, the demand for warehousing services and technology services are down.
A lot of people thought UPS was a heavyweight on that Challenger number, which explains your point. But Ed, so are we marching into an economy that's like strong growth, I don't know, 3-4% growth and high unemployment, where we could be looking at, 3% growth, 5% unemployment? Yeah. And is that really a good thing for the market?
Well, I've been talking about the roaring 2020s since 2020, and back then it kind of looked delusional, but I'm feeling better and better about it. No, I don't think that there's a fundamental problem in the labor market. I think there's structural problems, but they're really not problems. There's something we're just going to have to live with the fact that we've got a much slower growth rate in the labor supply, and at the same time, because of AI and other management tools that are being used to increase productivity and augment productivity, we're probably going to continue to have a very low unemployment rate. I don't see the unemployment rate going up a lot, and if that's the case, then the productivity is the story, and productivity is great for real wages. So what we lose on a slower head count, we're going to gain on wages rising faster than prices.
Page 1 of the Journal today, though, shareholders drive economy, but everyone else is wary. I mean, I remember your first mentions of the Roaring 20s analogy, but I don't think you were maybe leaning on the 20s were not a great period for equality.
Well, if you're talking about the 1920s, we had a tremendous increase in the standard of living because of technological innovations that improved people's lives. I think there's an analogy to today. The reality is a lot of the income and wealth inequality has a great deal to do with demography. We've got the most wealthy retiring generation ever in the baby boomers, and I know from personal experience, and including my friends' experiences, that we're helping the kids. It is a tough go there for young folks, but the reality is real wages are an all-time record high. Consumption per household is an all-time record high. So the macro data still looks pretty good, recognizing, of course, that there are people that are struggling and are not doing well.
Yeah, I mean, Ed,